Shares in the food delivery business had been offered to investors at 3.90p each, but dived in early London trading to 2.75p at one stage, a 30% fall. The company had initially hoped for a share price of up to 4.60p. But in recent weeks a number of high-profile fund managers said they would not be buying the shares. Shares later recovered some earlier losses to trade down about 10%. The Deliveroo share sale is London's biggest stock market launch for a decade. And the sharp fall on its first day of trading is a blow to the UK's ambitions to persuade more big tech companies to list in the UK. Chancellor Rishi Sunak said in March the listing of the Amazon-backed company was a true British tech success story that could clear the way for more initial public offerings by fast-growing technology firms. Deliveroo has gone from hero to zero as the much-hyped stock market debut falls flat on its face, said AJ Bell investment director Russ Mould. Initially there was a lot of fanfare about the Amazon-backed company making its shares available to the public, including the ability for customers to buy stock. Sadly, the narrative took a turn for the worst when multiple fund managers came out and said they wouldn't back the business due to concerns about working practices. Investor backlash. Deliveroo, which has not yet made a profit, said on Monday it had chosen to price responsibly and sell its shares at the bottom of its planned price range at 3.90p due to volatile market conditions. Some of the UK's biggest investment fund managers, including Aberdeen Standard, Aviva Investors, BMO Global, charity fund manager CCLA, Legal and General Investment Management and M&G said recently they would not buy shares in Deliveroo, citing concerns over including the working conditions of its riders and lack of investor power. Founder Will Shu will have shares that give him 20 times the voting power of other investors. Chief Executive Will Shu said he was very proud that Deliveroo was listing in London. In this next phase of our journey as a public company, we will continue to invest in the innovations that help restaurants and grocers to grow their businesses, to bring customers more choice than ever before, and to provide riders with more work, he added. Tech success. Deliveroo's self-employed drivers have seen a boom in demand during the COVID-19 pandemic, bringing food from restaurants to housebound customers. Initially, Deliveroo hoped to see that value as high as £8.8 billion, based on a share price of 390 to 460p. It scaled that back to £7.6 billion, but the share price drop wiped £2.28 billion off that. The firm is making a portion of its stock available for customers, with delivery riders and restaurant partners also able to buy shares. Deliveroo is selling just over 1/5 of the group, while institutional investing trading started on Wednesday. The general public can start trading in its shares from the 7th of April. What is an initial public offering? Private companies, as a way of raising cash, can start a process to list on a stock exchange. In an initial public offering (IPO), companies offer shares to investors before listing. The price of the shares is typically set by investment banks hired by the company to run the process. But once the shares start to be publicly traded, prices are set by supply and demand. The value of the shares, multiplied by how many there are, gives the market value of the company. Plain mispriced. Sophie Lund-Yates, equity analyst at Hargreaves Lansdown, said the biggest concern from investors was about worker rights. The flexible employee model of Deliveroo's riders is a huge pillar of the group's plans for success. If forced to offer more traditional employee benefits, like company pension contributions, Deliveroo's already thin margins would struggle to climb, and the road to profitability would look very tough indeed. She said it was difficult to value the firm as it had yet to turn a profit. Neil Wilson, chief market analyst for Markets.com, said that, even pricing the initial public offering at the bottom of the range, Deliveroo was demanding too high a price tag for a loss-making delivery platform in a very competitive space with a questionable path to profitability. The books were covered, it was just plain mispriced. Like, share and subscribe.